Good Tuesday. This is Jay Brew, co-chairman of Seafried and Brew. Dow once again down below that 11,000 level. Treasury rates on the longer end declining, so that when we see the 10-year in here this morning down to an amazing 1.92, led by international concerns, led by continuing from Friday's unemployment report, which still has pushed the entire curve downward in here. So as we look at it, is that we really want to think that big picture type of way of looking at these markets. And so we want to look at, for instance, what Dr. Ed has talked about on previous occasions, this whole aspect of the Fed's quantitative easing and their portfolio being on a constant basis in here going forward into the near future. And our two prongs of what could really change this. Of course, there's the prong of inflation. So when we look at inflation right now, not a problem. The other one that continues to lengthen this out longer term is the employment situation. So once again, what we would sit there and say is watch the employment numbers. Of course, employment coming out with that big zero in terms of non-farm employment. Still wondering a little bit how exactly it was exactly zero. But that zero is what changed so much here on Friday in terms of the overall market reactions. Unemployment, of course, staying steady at 9.1, but this would suggest that the Fed pushes out further and further towards their 2013 mark in terms of keeping interest rates low. So when we look at that too, is that we want to also think another prong in here, which of course is gas prices. And with gas prices moving downward in here, so we look at gasoline, the feeling would be is that this is going to have an economic benefit. Also, what we may be seeing where manufacturing, which really led us through our recovery up to the last couple of months where manufacturing started to decline, is that last week we got factory orders. And this number was sort of just completely disenchanted in terms of the way the stock market reacted, but we still have to look at the previous month factory orders, negative 0.8%. Suddenly factory orders in here rising a total of 2.4%. We got ISM manufacturing. That declined slightly in here, down from 50.9 to 50.6, which would still suggest an expansion over 50. But the good piece, which also went in with this factory order number, is that their new order index increased in here this past month, which I think is a good sign. Remember that we've spent weeks and weeks and weeks in here of just having bad numbers. Now we're starting to see some good numbers entering in. So there's a change going on that once again is not suggesting the recession that so many of the talking heads keep on referring to, that we're going back into recession. And it's still our opinion in here that once again that's not in the cards, but still things based on the employment picture are going to keep interest rates low for the foreseeable future. When we look at it also in terms of this talk that I gave last week, which interestingly enough, we had more hits on that particular talk than we've ever had before. And that was the whole aspect of dropping deposit rates down in here. And if you remember what I was saying is that I think that on core type deposits that you shouldn't be paying over 10 basis points for those core deposits. Along with it, look at CD rates, and we go back to where the 2-year is right now at 0.20, is that on longer CD rates, I would not be paying in excess of 0.20 in here for the foreseeable future. So when we think of that, is that suddenly bankers get scared. They're sitting there saying, gee whiz, if we lower our rates to that level and our competitors haven't changed, will people all start leaving? And I think that the big piece that you have to remember in here is, to some degree, if that money is really that rate sensitive, that then, as long as it's not a big relationship account to you, is that that money can leave. You can go and access, for instance, Federal Home Loan Bank very cheaply in here on short-term overnight money until you can bring back up that level of cash type deposits. So you could look at it in the same way, is that if you do have rate shoppers that are sitting in those accounts, it's better to get rid of them now at this low level of rates than to have to replace that money if and when we have interest rates heading higher. The other aspect that people talked to me about last week is also this whole deposits coming in like crazy and the whole thing of collateral. And when we look at putting collateral against a particular collateral deposit, is that collateral is expensive in here, especially where interest rates are on investments in here that would create that collateral to back those deposits. So when we look at this pledging issue, it's very expensive in here, especially if you're pushing up on your limits on your collateral. You can go out, for instance, Federal Home Loan Bank will provide letter of credits, but that's expensive. That's 10 basis points. And gee whiz, there isn't a lot of margin when we're talking about cutting rates to that degree to have that payment of the 10 basis points. So we want to consider, one, do we really want these deposits that we're going to have to back with collateral? Or do we want to try to do other deposit gaining situations of bringing in more cash type deposits at lower rates based on then not having to use collateral? So this is going to be a big question coming up over the next year with rates as low as they are, with securities running off. Do you really want to be in a position where you're going to have to go out and buy collateral? It could also be a situation where, like we were talking about last week, is that some of the banks are being forced to actually charge customers money in terms of being able to collateralize large deposits. And could it be coming up that what we're going to see is that if different depositors require collateral going into the future, that you're going to have to sit there and determine maybe they're going to have to pay you for that right. Anyway, this is Jay Brew. Have a great week, co-chairman of Seafried and Brew.